Subscribe to our YouTube channel, Joy Learning TV.
Hello viewers and students, welcome to Joy Learning channel. I'm taking you Financial Accounting Form 1 and my name is Adade Gottlieb. So our topic for the day is accounting equation. Accounting equation. Accounting equation. So by the end of the lesson, you should be able to explain some terms on this topic. Define element of accounting equations. State accounting equation. Identify two main accounts of a transaction. Then explanation of some of the terms. So business, what is a business? So occupation, work or trade. Business. Business. So transactions, what is meant by transaction? An act of conducting or carrying out business. That is transaction. A deal or business agreement. So that is a transaction. So buying, selling, yes, conducting or carrying out a business or a deal or business agreement known as what? Transactions. 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 Now, what is accounting equation? So, accounting equation, so in mathematics you also talk of equation. The same way in accounting we talk of equation. So, over here, we're looking at our assets, capital, and liabilities. So the prepositions of assets, capital, and liabilities, known as what? Accounting equation. So it is a preposition that a company's assets must be equal to the sum of its liabilities and capital. We're going to look at it briefly. So your assets should be equals to your liabilities and capital. So the combination of this is accounting equation. So when we talk of accounting equation, the elements are assets, capital, and liability. The assets, the capital, and liabilities of the business. That is accounting equation, the elements. Elements. Then what is an asset now? What is an asset? So basically, all resources of the business or the properties of the business, properties of the business, all the resources of the business are regarded as assets. And these, anything that is an asset, you must bring economic benefits. That is an asset. Assets. So let's look at it. Are resources controlled by an entity as a result of past events and from which future economic benefit must flow to the enterprise. So when you are saying something is your asset, then it means that there should be a benefit that must be driven from that particular asset. Assets. So assets. All resources controlled by the organization as a result of past event, which economic benefit must flow into the enterprise. Properties, anything you have are your assets. So as a student, what are the things you have? All the things you have are your assets. So as a business, the business is also having its properties or its resources. So that is an asset. Assets. So they are not anything they mention, you will be thinking all the things you have are your assets. So all the items, properties, resources that are owned and controlled by the business regarded as what? Assets. Now, what are the main classifications of assets? We have a lot of classes of assets, but we have main classifications. What are the main classifications? So we have fixed or non-current assets. Non-current assets. Non-current assets. So what is a non-current asset? So an asset that you have bought or you have, and the intention is not to sell the asset, but to use it for more than one financial year. That is a non-current what? Asset. The intention is not to sell the asset, and is meant to be used in the business for a long period of time. That is a non-current asset. So one of the classifications of assets, non-current assets. So they are resources acquired, not for resale, but for running the business of an entity. You are not to sell the intention is not to sell the asset. That is a non-current asset. What are the examples? Land and building, plant and machinery, furniture and fittings, motor vehicles, and a lot. So you acquire a property now, but your intention is not to sell that property, but to use it for a long period of time. That becomes your non-current assets. Non-current assets. So you'll be able to give examples. Land and building, plant and machinery, motor vehicle, furniture and fittings, and all that. So you acquire an asset now, but it is not your intention to sell that asset, but use it for a long period of time, more than one financial year. The asset becomes your non-current assets. Then current assets. So current assets are expected to be converted into cash within one financial year. So this one are meant to be sold and all that, or to be converted into cash within the year. So they are held purposely for being traded, for trading activities. Examples: stock or inventories. Inventories. So when we talk of stock, we are talking of what? Inventories. Inventories. And what are inventories? Anything that the business is trading in are what? Inventories. Debtors, bank, cash. These are examples of a current asset. So debtors. So you have to know what are assets. Main classifications of assets. And then there are respective examples. So for current assets, inventories, trade receivables or debtors, bank, cash. These are examples of a current asset. Current assets. Now, what is a liability? What is a liability? So all financial obligations of the business. Do we have to pay some people outsiders? All owings of the business. That is a liability. So basically, anything that is a burden on the business will be regarded as a liability. So when somebody tells you you are a liability, means you are a burden. So anything that is a burden on the business will be regarded as what? A liability. So anything the business has to pay, anything that is a burden on the business for the business to pay is what? A liability. So all financial obligations of the business, or all the owings of the business, regarded as a liability. So these terms, you have to get them. They are not difficult. Once you have gotten them, everything will be very easy for you. That is why you need to continue to watch the Joy Learning channel. Now, so entities' obligation to transfer economic benefits as a result of past events, or it can also be considered as owings to outsiders. Owings to outsiders. What we have to pay outsiders. That is a liability. So same, what are the classifications? What are the main classifications of a liability? So we have long-term or non-current what? Liability. Long-term or non-current liability. So you have a financial obligation that you are supposed to settle more than one financial year. More than one financial year. An example is loan, debentures. So you go for loan, you pay it more than one financial year or 1 year. When we talk of one financial year, we are talking of 12 months. So which may begin from anywhere in the year. Sometimes mostly it coincides with January, in the normal year, January to December, but financial year could begin from anywhere. So you should know. But wherever it is starting, it should be 12 months. So you have acquired a loan or you have gone for a loan and you use more than 1 year to pay. That is an example of a non-current liability or long-term liability. So these are debts that will fall due beyond one financial year. So examples, loan, debentures, loan, debentures, debentures. Then short-term or current liabilities. Current liabilities. So all burdens of the business or financial obligations of the business which must or which are within one financial year. Before the year ends, this should be settled. All debts or financial obligations of the business that must be settled within the year are short-term or current liabilities. So get used to these terms. Get used to them. Once you understand them, you get the basis, everything will be easy as you move along. So these are debts or amount expected to be paid within a year. So what are the examples? You have creditors or payables, trade payables. So for instance, you purchase on credit. You cannot say after 1 year before you pay. So let's assume that you need something now and you know the person who is selling it. So you have gone to purchase this, or let's assume in the morning you have gone to purchase a porridge on credit. Will you say after 1 year before you pay the person? When you are throwing the person out of business. So these debts that you are supposed to pay within a year are short-term or current what? Liabilities. So creditors, bank overdrafts, expenses owings, and income prepaid are examples of a current what? Liability. Examples of current liabilities. So creditors, bank overdrafts, expenses owings, and income prepaid. Examples. So when your cash book is having a credit balance and you have taken more money than what you have in your accounts, so in that case we say that you are in the red. So that is a bank what? Overdraft, which mostly must be settled within 3 to 6 months. So it's a burden on the business by short term, which must be settled within one financial year. So that is an example of current liability. Then expenses owings, any expense we have to pay, we couldn't pay, all these are liabilities. So we have to pay light bill, water bill, we couldn't pay, salaries, wages, we couldn't pay, owings. So these are burdens or liabilities of the business which must be settled within a year. Income prepaid. Income prepaid. Income prepaid. So you receive an income that you have not worked for is a liability to the business. A liability to the business. So what is meant by this? So let's assume that we are producing laptops and a company has already paid all money for us to produce as a business. So we have not produced the items yet. So that money that we receive is income what? Prepaid. So it's a liability on us. It's a burden on us. So the company can decide that no, it's okay. They don't need the laptops again. So what do we need to do? We have to refund the money. So income prepaid are liabilities. So we'll get some of these terms. Then what is capital? What is meant by capital? So we are looking at the element of the equation. So we explain an asset. We look at the main classifications of assets. We explain liabilities and also look at the main classifications of liabilities. So now, capital. What is a capital? So capital, we may say, all resources invested into a business. Any resource invested into a business will be regarded as what? Capital. So when we talk of capital, it could be money. So an instance, you want to sell a bread, you are using your private car to sell, that car becomes a capital. So not only money when a capital is being mentioned, it could also be a property as well. Anything you have invested into a business will be regarded as a capital. So you may decide to use part of your building for a store, for a business. So that part becomes a capital. So and the money you also invest, the money you also put into the business. So when we talk of a capital of the business, all resources, any resource invested into a business will be regarded as capital. So it is a residual amount found by deducting all liabilities of an entity from all the entities' what? Assets. So all the residual, we're going to look at the equation. All the residual from the asset will be regarded as capital. Now, accounting equation. Let's look at the accounting equation. Now, A denotes assets and C for capital. And what is meant by this? So, as every equation should balance, same should be done here. The equation must balance. This equation must balance. So we say A equals capital or asset equals capital or A equals C. Now, or the C, which is the capital, is also known as equity. You may see this in your objectives. Owner's equity or equity. Now, you want to set up a business. You are able to save some money. Then you use it to acquire the properties of the business. So if you use it to acquire the properties of the business, then your assets equals your capital. The money you have is enough for you to set up your business. So if you do that, then it means you don't need any hands from any external source. So your asset equals your capital. So the money you have saved, you use it to acquire the properties of the business. So that is your asset equals your capital. Your asset equals your capital. So what all money saved or contributed by the owner is used to acquire the properties of the business. So you don't need an external hand for you to establish your business. In that case, your asset equals your capital. Now, let's look at this. Your asset equals your capital plus liabilities. So again, capital is also known as owner's equity. Owner's equity. So your asset equals capital plus liability. So now let's assume that the money you have saved or contributed is not enough to acquire the properties of the business. So you need hands from any external source. So you have gone to friends, financial institutions to take loan and others to add up to whatever you have saved to acquire the properties of the business. So in that case, then it means that the money you have saved plus the one you have gotten from the outside, whether your friends, financial institution, or whatever, you add it to whatever you have said to acquire the properties of the business. So in that case, your asset equals your capital plus liabilities. Therefore, the fundamental accounting equation is what? Asset equals capital plus what? Liabilities. I think this is very simple for us. This is very simple. Very, very simple. Your asset equals capital plus liabilities. Or your asset equals your owner's equity or equity plus your liabilities. Your liabilities. So the relationship between asset, capital, and liability is the fundamental accounting equation. The relation between these three terms, assets, capital, and liabilities, will be regarded as accounting equation. So anytime this equation must balance, any of the elements can be made the subject. So for your objective, any of them can be made the subjects. Any of them can be made the subject. So you have the fundamental is asset equals capital plus liabilities. So C can be made the subject, L can be made the subject. Already A is already the subject of the equation. So any of them, so objective, your objective, what can be done is this. Which of the following is accounting equation or which of the following is not? So making which of the following are accounting equation. So you make all of them the subject, you get your accounting equation. So any of them that could not conform to this, those you have made a subject of will not be accounting what? Equation. So let's look at them. So your asset equals capital plus liability. That is the fundamental, the first one we had a look at. Your asset equals capital plus liabilities. Then if we decide to make C the subject, so this one will be a simple mathematics for you, change of a subject. So if we are making C the subject, then L will go. So we have our capital or owner's equity equals asset minus liabilities. Asset minus liabilities. So the same way, if we are making L the subject, our asset minus what? Capital. So these are examples. These are examples of a accounting equation. Examples of accounting equation. So which of the following is accounting equation? Which of the following is not? We should be able to select that. Should be able to do that. Now, identification of the two main accounts of a transactions. Now, what's happened is that for every transactions, you should be able to identify two main accounts. You should be able to identify two main accounts. So, summarized form of a transaction, that is an account, should be able to identify two main of every transaction. So what we should know, we have left hand side, which is debit, and the right hand side, which is what? Credit, always. So you have debit and credit. Debit, credit. Debit, credit. Okay. So let's look at it. So for every business transaction, two main accounts must be identified, or which one must be put at the left-hand side, your debit, and the other at the right-hand side, credit. So mostly this is done when double entry is going to be what? Observed. And this will be our next topic. So I continue to urge you so that you follow the lesson to the end. So you continue watching the channel. So let's consider these examples of a transaction so that we identify two main accounts. Two main accounts. So let's look at this. John commenced a business with 500 Ghana cedis cash. John commenced a business with 500 Ghana cedis cash. Now, what will be the two main accounts here? Two main accounts. So, we have seen we have cash. So, cash is one. Then the next one is capital. Please, you can't mention John. John can't be mentioned here. So, means John is the owner of the business. So, John cannot have John in his own account. So, and we also learned that anything you invest into a business is known as what? Capital. And this capital is in a form of what? Cash. So, the two main accounts here are what? Capital and cash. So, upon reading the transactions, you should be able to identify the two main classes of accounts in every transaction. And these are the fundamentals of the accounting. Types of accounts should be able to identify. So over here again, John commenced a business with 500 cedis cash. So we have here capital and cash. So these are the two accounts. Next one, cash sales to brides, 200 Ghana cedis. Think of it. Cash sales to brides, 200 Ghana cedis. 200 cedis. What are the two main accounts? Cash sales. Okay, so I hope you guess something. Now, we sold cash. That is what is meant by cash what? Sales. So we sold instantly. The money is received in a form of cash. So cash sales. So the two accounts are cash and sales. You do not need the name of brides. So if you are selling cash, you don't need the name of the people. So there's no need to bring the name into the scene here. Otherwise, if you go to purchase and sell, then you need everybody you transact with in your book. No. It is when it is on credit. If the transaction is on credit, then the name of the person is needed. That is if you sell on credit. But this one, cash sale, we sell instantly, the cash is taken. So there's no need to write or have the person from whom the goods are, or the person to whom the goods are sold. We don't need the person's name in our book. So the two accounts will be cash and sales. Cash and sales. Cash and sales. Deposit 400 Ghana cedis at the bank. So you are taking money from the business to the bank. What do you think will be two accounts here? What will be the two main accounts? Deposit 400 cedis at the bank. At the bank. So the same way, and a common example is you have too much money on you, so you decided to put some in your Momo. So sending money from the business to the bank. So when we are taking a cash book, this is what is known as contra entry. Contra entry, where the transaction affects cash and bank at the same time. So what is happening here? So the two accounts are cash and bank. Cash and bank. So the two accounts, cash and bank. So we'll be looking at when this is, once you have known how to identify two accounts, we'll be looking at the effect of these transactions on the equation. Effects. So deposit 400 Ghana cedis or deposit 400 Ghana cedis at the bank. So cash and bank. Cash and bank. Bought goods, 300 cedis on credit from Philip. Bought goods, 300 Ghana cedis on credit from Philip. Think of it. Double entry. So what will be the two accounts here? Bought goods, 300 Ghana cedis on credit from Philip. On credit from Philip. So, all the examples we had a look at this one, I think you could agree that we should have this person in our book, who is Philip, because we purchase goods from this person. Now the question is, who is this person to the business? Who is this person to the business? So we purchase, so is our supplier or creditor or trade payable. So what are the two accounts then? Purchases and Philip. Purchases. So you can't bring cash or bank here, because the question has told us that it's on what? Credit, that word. So which means there's no cash, there's no check or bank. It's on credit. It's on credit, which means that the payment will be done later. So there's no cash element, there's no check element. So that is, so the accounts we have will be what? Purchases and Philip. Purchases and Philip. So the moment you read the transactions, you should be able to get or identify the two accounts. Now, and one thing you should also know is this. One thing, when you are identifying the two accounts, we have purchases, we have sales. Now, if the name of the item is being mentioned, then you don't bring sales, you will not bring purchases. For instance, if it is bought motor vehicle on credit from Philip, bought motor vehicle, the name of the item is mentioned here. Just giving an example of this. Bought motor vehicle, 300 Ghana cedis from Philip, then purchases will not be part of the account. So you use motor vehicle and Philip. So when the name of the item is mentioned, then you leave sales and purchases. Then you use the name of the item given to you, and if it is on cash, if it is cash. If it is on credit, then the name of the person or trade payable. So you get some of these rules. Now, credit sales, 450 cedis. Credit sales. Think what will be the two accounts here? What will be the two main accounts? Credit sales, 450. Credit sales, 450. 450. Credit sales. So, if we sell on credits, what's the name we are selling on credit? No name has been mentioned. No name has been mentioned. So this is a credit sales. What do you think will be the two accounts here? So sales is constant, sales, and then debtors or trade receivable. Debtors or trade receivable. So the two accounts are sales and trade receivables. Sales and trade receivables. So if you sell on credit, the name of the person is a debtor or receivable, trade receivable. Trade receivable. So if you sell on credit, that person is a debtor. If you purchase on credit, the person is a creditor, supplier, or trade payables. So you will get these two words well. Paid suppliers, 3,500 cedis. Paid suppliers, paid suppliers, 3,500 cedis. What will be the two accounts here? So I hope you get it right this time. Paid suppliers. So suppliers as one, and the common base we can use here will be cash once we are making payments. So suppliers and cash. Suppliers and cash. Suppliers and cash. So these are the ways to identify two accounts of every transactions. Every transactions. And one thing we should also know when you are preparing the account or doing all these things, when you sell, you always, before your transactions will be right, you should always stand in the position of the business. If sales, you are the one selling. Purchases, you are the one who purchase. So you always stand in the position of the business. So the issue is this: if I sell to you, I will do my recording. I don't care whether you record yours or not. So always, for your record to be accurate or right, you have to stand in the position of the business. So in that case, you get all your. But if you are looking at it from the other point, then your records will be wrong. Now, let's look at the effect on transactions on accounting equation. Effect of transaction on accounting equation. So, now the equation, the two main accounts should either be asset, capital, liability, or have a link with any of the elements. In all situations, the equation should balance at any point in time. So, once we are saying it is an equation, it should balance any points. It should balance. Now, let's have or look at the effect of transaction on equation. So, what is the equation then? We're talking of assets, owner's equity or capital, and liability. And liability. So, when we talk of an effect of a transaction on accounting equation, so we're going to talk about either increase or decrease. Are they increasing or they are decreasing? Are they all increasing? So let's look at it. Let's look at this. Now if we have the accounting equation, so our assets equals capital plus liabilities. Our asset equals capital plus liabilities. So if we have assets equals capital plus liability, now let's look at it. We have our asset, we have our capital, and we are saying that the equation should balance. So if you identify an account where one is an asset, the other is either capital or liability, then what will happen for the equation should balance? They should all increase or they should all decrease. Please get it again. The equation should balance. So if you identify the two accounts, you are looking at the effect. Which one must increase, or either they should all increase, decrease, or one must increase, the other decrease. So let's look at the rule of the game then. We identify an account. Then one is an asset and the other is either capital or liability. So which means that one is here, the other is here. So when it happens that way, either they should all increase or they should all decrease for the equation to balance. Now, if you identify the accounts and they are all at one side, either they are all assets or they are all liabilities, then what should happen is that one should increase, the other should decrease so that it will become zero for the equation to balance. So this is the rule we're going to observe. So with this rule, it will guide you as to the effect. You should be able to state the effect well. Again, if they are all at one side of the equation, one will increase, the other will decrease, so that it will become 0 for the equation to balance. But if one is the other, each in other side, then one will, either they should all increase or they should all decrease. So now let's look at this. Let's look at this. Started a business with 3,000 cedis. Check. So now we have the two accounts to be capital and bank. Capital and bank. So the bank is an asset. We had a look at it when we were looking at a current asset. Bank is a current asset. Therefore, bank simple is an asset. It's an asset. So if it is an asset, then we have it here. We also have capital here. So the rule of the game is that if one is at this side, the other one is also here, they should all increase or they should all decrease. So in this case, what is happening? Our bank will increase and then our capital will increase. So increase in asset, bank. Increase in capital, capital. So the two are all increasing. The two are all increasing. The next one, purchase goods worth 200 cedis paying by check. Purchase goods worth 200 cedis paying by check. Now, what will be the effect here? So goods. Now, the rule is that we are looking at it on the point of accounting equation. So anything you should mention should be either capital, asset, or liability. Okay, so purchase goods worth 200 cedis paying by check. So our bank, I hope you can identify that one first. Bank accounts, bank. Then purchases. In accounting, when we talk of purchases, purchases of inventory, stock. So what is happening here? So we have an inventory here, or inventory, or stock here. So we purchase goods. So that is an asset, the stock or the inventory. No, so if that is the case, they are all assets. If they are all assets, then one must increase, the other will decrease. So what do you think then? So we are making payment by giving check. So what will happen to our bank account? Our bank account will reduce. And what we are purchasing, the inventory is coming to the business. So what is happening? Increase in asset inventory, decrease in asset bank. So you observe these rules. Now, withdrew cash of 1,000 cedis from the bank for business use. So we are taking money from the bank for business use. So it means all these are also what? Assets. So we have cash and bank. Cash and bank. Cash and bank. So what is going to happen here? So withdrew cash 1,000 cedis from the bank for business use. So you agree that the bank account will do what? Will reduce. And the cash in the business will do what? Will increase. So increase in assets, cash. Decrease in assets, bank. So because they are all at one side. If they are all at one side, one must be positive, the other will be negative for the equation to balance. So in that case, it will become 0 for the existing equation to continue balanced. Bought goods on credit, 300 Ghana cedis. Bought goods on credit, 300 Ghana cedis. What will be the effect on the equation? Bought goods on credit, 300 Ghana cedis. 300 Ghana cedis. Bought goods on credit, 300 Ghana cedis. Okay, so the goods are on credit. We bought the goods on credit. So inventory, that is one. Then it is on credit. So what are we talking about? Trade payables or creditors or suppliers. So which means that we purchase goods. So inventory, an asset, and then the supplier or the trade payable or a creditor being a liability. So we have one at the right and the left as well. So in this case, they should all increase or decrease. All depends on the situation. So let's look at it. So the issue is, once you know if you have it at both sides and one automatically is increasing, means that they are all increasing. So it's just a matter of you to identify one of them. Is it increasing or decreasing? So once it is decreasing, or if it is increasing, or that is if you have them at both sides. Okay, so bought goods on credit. So now increase in asset inventory. Increase in asset inventory and increase in what? Liability, a supplier or trade payable. So our assets will increase, our liabilities too will increase. So for the equation to balance. So remember, at any point in time, the equation should do what? Should balance. The equation should balance. Contracted a loan of 500 Ghana cedis and deposited it at the bank. You contract a loan of 500 Ghana cedis, deposit at the bank. What will be the effect on the equation? What will be the effect on the equation? You contracted a loan, then this loan is then sent to the bank. Is sent to the bank. So what will be the effect? Once we are saying effect on the equation, we are talking of increase and decrease. And also, we should be mindful, we should not mention anything at all. It should be either assets, capital, or liabilities. So we contracted a loan, that is a liability, long-term or non-current what? Liability. And this money is being sent, this loan is sent to the bank. So if it is sent to the bank, means our bank account will do what? Will increase. So our liabilities are increasing by loan and our assets also increasing by the bank. So increase in asset, bank, increase in liability, loan. Increase in asset, bank, increase in liability, loan. So our liabilities, once we contracted a loan, our liabilities are increasing. And then this same loan is deposited at the bank. So our bank account will increase by the quantum of the loan taken. To increase in assets, bank, increase in liability, loan. Bought van, 500 cedis cash. Bought van, 500 cedis cash. What will be the effect on the equation? Effect on the equation. Bought van, 500 cedis cash. So you agree that your cash will decrease. So van is an asset. Cash is an asset. Van is, well, a non-current asset, and cash is a current what? Asset. All depends anyway. So with this, what is going to happen? So we bought van, so increase in assets, van, decrease in assets, cash. So this is how you analyze Then paid suppliers, 250 cities check. So now we have suppliers and bank. So what is going to happen? We are paying. So if you are paying your supplier, your suppliers are decreasing. So decrease in liability, supplier, and decrease in asset, bank. Decrease in liability, supplier, decrease in asset, bank. Then 200 cities cash from the business for personal use. So you are taking money from the business for personal use. So decrease in asset, cash, and decrease in capital, drawings. So now what you should know is that when you take something from the business, you are reducing the capital of the business. Cash sales. So we are selling. What is going to happen? So increase in asset cash, decrease in assets inventory. Cash purchases. So increase in asset inventory and decrease in asset cash. So these are the things we need to, these are the effects on the equation. Now, so what is going to happen is that all the increases are positive. So you write your dates, van, all the assets and liabilities capital in the question. When it is increased, you indicate plus. For instance, our bank increased, the first one, and our capital also increased. So you see plus there. So when it is increased, plus, decrease, minus. So at the end of the day, you sum them up. And all things being equal, if you add all the assets, should be equal to your capital and what? Liabilities. And same can be presented in the statement of financial position. So you pick the totals. So when you add all, your van will be 500, stock will be 250, your bank will be 2050, cash 650, and then your capital 2,900, loan 500, and creditor 50. And all things being equal, it should balance, because we said the equation must balance. So these are the things on accounting equations. So, and you should be able to explain the terms and then identify two main accounts. So the next thing will be the double entry on this. So these are the things we need to learn on accounting equation. And I hope you have enjoyed this lesson. So it's not difficult. Once you pay attention and you continue to watch the channel, I hope you will learn here perfectly. And you'll be able to get all the concepts that you cannot even get in your various schools. So I entreat you to keep on watching the Joel Learning channel until we meet next time. Thank you.
Subscribe to our YouTube channel, Joy Learning TV.